$200 a month. That is $6.60 per day. It is 2 fewer restaurant meals per week. And invested consistently, over a long enough time horizon, it becomes $1 million. Not through luck. Not through picking the right stock. Through math, specifically through compound interest, which Albert Einstein may or may not have called the eighth wonder of the world, but which absolutely is the most powerful force in personal finance. Today we are going to run this math precisely. We are going to show you what different amounts at different ages produce, explain the 3 levers you actually control, and explain why the attempt to do better than boring usually produces results that are dramatically worse. Let us start with the base case. $200 per month, invested in a broad S&P 500 index fund earning the historical average return of approximately 10% annually. How long until you reach $1 million? The answer is 40 years. 40 years of $200 per month equals $96,000 in total contributions, less than $100,000 of your own money. The remaining $924,000 is pure compound growth. The market did the work. Now let's increase the contribution. $500 per month at 10% over 40 years becomes $2.55 million. $1,000 per month becomes $5.1 million. The math is not linear, it is exponential, which means each additional dollar you contribute has dramatically more impact than you intuitively expect. Here is the crucial insight: the end number is dominated by the later years of growth, not the early contributions. In year 1 you might earn $240 in gains on a $2,400 balance. In year 39, you might earn $96,000 in gains on a $960,000 balance. The account is essentially printing money in those final years, but only if you started early and stayed invested long enough to reach that phase. There are exactly 3 variables that determine your final portfolio value. I call them the 3 levers. Lever 1, amount contributed per month. This is the lever most people focus on, and it is the right one to start with. Increasing your monthly contribution from $200 to $400 does not just double your outcome, it more than doubles it, because the extra money also compounds. More input means exponentially more output. Lever 2, time. This is the most powerful lever and the least appreciated. We will show the age tables in a moment, but the core principle is this: every year you delay costs you far more than the money you did not invest. Time is irreplaceable. You can always earn more money. You cannot recover lost compounding years. Lever 3, rate of return. This is the lever people obsess over and spend the most energy on, and it is the least controllable. The average investor trying to beat the market by picking stocks, timing the market, rotating into sectors, or chasing last year's winners does not earn more return. They earn less. We will cover the data on this in a few minutes. The implication is clear: optimize lever 2 first by starting immediately, optimize lever 1 by automating contributions and increasing them over time, and stop obsessing over lever 3. Let me show you the most important table in personal finance. I am going to show you what $200 per month produces depending on when you start, all else being equal, all at 10% annual returns. Starting at age 25 and investing until age 65, 40 years, you end up with $1.02 million. Total contributions, $96,000. Starting at age 30, 35 years, you end up with $621,000. You contributed $84,000. But you lost $400,000 in outcomes by waiting 5 years. Starting at age 35, 30 years, you end up with $379,000. 30 years of discipline, $72,000 contributed, and the outcome is less than half of what the 25-year-old gets. Starting at age 40, 25 years, you end up with $236,000. A respectable sum, but less than a quarter of the early starter's outcome. Every 5-year delay roughly cuts your outcome in half at the same contribution amount. This is why starting at $200 per month at 25 beats starting at $800 per month at 40. The math is unambiguous. Now let us look at what happens if you increase the amount as your career progresses. Start at $200 at age 25. At 30, increase to $400. At 35, increase to $600. At 40, increase to $800. At 45, increase to $1,000. At that stepped-up pace, aligned with typical career income growth, you are looking at a portfolio well above $1.5 million by 65. This is completely achievable on a median American salary. Now let us talk about lever 3, the return rate, and why trying to improve it typically makes things worse. The average annual return of the S&P 500 from 1928 through 2024 is approximately 9.8%. Call it 10% for round numbers. That includes the Great Depression, World War II, the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, and every other disaster in between. Just holding the index through all of it produced 10% per year on average. Now here is what most active investors actually earn. The DALBAR organization has been studying individual investor returns versus the S&P 500 for over 30 years. Their most recent comprehensive data shows the average equity fund investor earns approximately 5.5% per year versus the S&P 500 at 9.9%. The gap is 4.4 percentage points, and it is entirely caused by behavior. Investors buy after markets go up and sell after markets go down. They rotate into whatever performed well last year. They panic in crashes and sell at the worst possible time. They chase crypto when it is up 300%, and they exit when it is down 70%. The result is that active attempts to beat the market consistently produce worse outcomes than simply buying the index and ignoring it. Let us run the math on the behavior gap. $200 per month for 40 years at 9.9%, the index return gives you $960,000. The same $200 per month at 5.5%, the average investor return, gives you $346,000. The behavior gap costs you $614,000. That is more money than all of your contributions combined, lost entirely to emotional decision-making. Let me give you the 4 behaviors that produce the gap, and the single solution that eliminates all 4 of them. Behavior 1, panic selling. Markets crash. They always have and they always will. The average investor sells somewhere near the bottom and re-enters somewhere near the top. Each round trip costs them 10 to 15% of portfolio value. Behavior 2, performance chasing. Whatever sector or asset class dominated last year attracts capital at exactly the wrong time. Tech stocks in 1999. Housing in 2006. Crypto in 2021. The pattern never changes and it always ends the same way. Behavior 3, market timing. Waiting for the right time to invest. The evidence is unambiguous: time in the market beats timing the market. Missing just the 10 best trading days in any given decade cuts returns roughly in half. Behavior 4, overtrading. Every transaction has a cost. Active trading accounts have lower returns on average than passive buy and hold accounts, not because of transaction fees alone, but because making more decisions gives you more opportunities to make wrong ones. The single solution that eliminates all 4 behaviors: automation. Set up an automatic monthly transfer from your checking account to your investment account on payday. Set it to invest automatically into a total market or S&P 500 index fund. Then do not touch it. The automatic transfer removes the decision point. You never have to decide whether to invest this month because it already happened before you could intervene. The investment goes in regardless of whether the market is up or down, which actually works in your favor through a mechanism called dollar cost averaging. When markets are down, your $200 buys more shares. When markets are up, your $200 buys fewer shares. Over time, your average cost per share ends up below the average price, because you systematically bought more when things were cheap. The best brokerage accounts for this are Fidelity, Vanguard, and Schwab. All offer automatic investment plans with zero transaction fees on index funds. Set the amount. Set the date. Set the fund. Walk away. Increase the contribution by $50 or $100 every time you get a raise. Treat the increase as already spent, invest it before lifestyle inflation can capture it. That is the entire system. It is boring by design. Boring works. The DALBAR data proves that excitement in investing is not a feature, it is a bug. Here is what to do this week. Open a brokerage account if you do not have one. Fidelity and Schwab both have zero minimums. Set up an automatic monthly transfer even if it is $100 to start. Buy a total market or S&P 500 index fund. Set it to auto-invest. Increase the amount by even $10 per month until you reach $200, then keep going. The math is not complicated. The discipline is not complicated. The only thing that is complicated is overriding the emotional instinct to do something clever when boring is provably better. $6.60 per day. 40 years. $1 million. Start today. Word count, 1 300 duration, 10-minute end card. Next video, he paid off a $380,000 mortgage in 9 years, the exact method.